Welcome to The Long-Term Investor. I'm Peter Lazaroff, and today with me is the one and only Bob Pisani, Senior Markets Correspondent for CNBC and author of Shut Up and Keep Talking, Lessons on Life and Investing from the Floor of the New York Stock Exchange. Bob, I've seen you on TV for years. This is a huge pleasure for me. Thanks so much for joining me today.
Peter, pleasure to talk to you. I'm in the basement of the New York Stock Exchange where I've been since 1997. It's a wonderful place to work and be, and working for CNBC for 35 years. It's just been fantastic.
Well, take us back to 1997. I know that you didn't come into this business as a markets guy. What was it like when you stepped onto the NYSE floor for the first time?
Well, I had been the real estate correspondent from 1990 to 96, became the stocks correspondent in 97. And when I came on the floor, I didn't know it, but this was the very height of the whole New York Stock Exchange and really the height of the 1990s. When I came on the floor, there were 4,000 people on the floor doing open outcry. That means brokers screaming at the specialists. And they did 80% of the volume on the floor, 80%, 4,000 people doing 80% of the volume. Today, thanks to technology, there's 200 people that do maybe 15% of the volume. So a lot of big changes down here, but the basic core, the idea of providing an efficient place to trade stocks hasn't changed.
Well, and I mean, you've witnessed the shift from brokers shouting on the floor to electronic trading algorithms. I mean, I guess, what do you feel like are some of the most profound changes in how markets function and how investors even access them?
Well, the biggest thing, a couple of things I've seen is obviously electronic trading from, like, as you mentioned, open outcry to now essentially we're matching orders on computers. Although the floor still exists, you still can do trading on the floor. The other thing is decimalization. So when I got here in 96, when I was first down here before I became a stocks correspondent, they were trading in eighths. The spread was 12.5 cents. And in 1997, it went to a 16th, which is 6 1/4. Imagine how profitable it is when your spread is 12.5 cents. And then it went to a penny in 2000. So it was an extremely profitable business. And obviously the profitability dropped dramatically, but that was a good deal for investors. Going to pennies saved a lot of money for people. The other thing I would think that was important that I saw was the birth of ETFs and passive investing. It was very hard for investors to invest with the market. Up until Jack Bogle introduced the first investable index fund, Vanguard's S&P 500 fund, in, I believe it was 1974-5. But prior to that, it really was very difficult. And what people realized, and the market historians and people who are professionals realized, is that it's very hard to beat the markets. In fact, it's almost impossible over many, many years, and that you want to stay with the market. And the birth of ETFs in 1993, the first S&P 500 ETF came out, made it easy for people to just own the stock market. That tremendously helped investors because it was low cost and they didn't have to worry about what stocks to own. You essentially own the S&P 500, you own the vast majority of the market. The other thing I think that's really important is the birth of behavioral finance. And I saw this in the 90s because behavioral finance attempts to show individuals how individuals are really behaving, not how they're supposed to behave. There were models, that went back, hundreds of years that human beings acted rationally, that you bought low and sold high. That was the whole idea, right? Buy low, sell high. Well, it turns out studies have indicated they don't. They buy high and sell low. They panic. And so the study of why they panic and why they act irrationally became known as behavioral finance. And it's really deepened our understanding of markets and why some stocks get ridiculously overpriced, some stocks get ridiculously underpriced. So I would say birth of electronic trading and decimalization, the birth of ETFs and passive investing, and the understanding of consumer behavior through behavioral finance. Those are the big three things that I've seen in the last 35 years.
So many strings to pull on. Before I get into some of the bigger philosophy ideas, you're mentioning some of what I consider to be like the plumbing of markets. I mean, do you think that retail investors even understand how much that has changed, or do you think it still mostly remains behind the curtain?
Oh, it's mostly behind the curtain, and it should be. I mean, look, Arthur C. Clarke, I grew up reading science fiction in the 60s, and Arthur C. Clarke and Isaac Asimov were my heroes. And Arthur Clarke, who wrote 2001: A Space Odyssey, once said, any sufficiently advanced technology has the appearance of magic. And if you look at it, I mean, think about it. You are able to sit at your home, press a button, say, I want to buy 100 shares of IBM, and the order gets executed in a sub-second interval, you get a confirmation. I mean, that's kind of a miracle if you think about it. Yet there's a very elaborate, long, decades-long process of development in hardware technology, development in software technology, development in what we call market structure technology that had to come together to allow that to happen. I know a lot about the history, but most people don't care. And why should they care? I don't know all the intricacies about how a plane flies, but I know it flies. There are engineers who know. So I know a lot about it, but I'm the markets reporter. Airplane engineers need to know about it, but I don't need to know exactly how a plane flies or an automobile works or how nuclear fission or fusion works, but they do. So yes, it's changed dramatically, and most of it's still behind the curtain. And what people care about is when you push the button, the thing works. The car starts, the stocks get traded, and that's far and away the most important thing.
That's a great point. And you've already mentioned so many things, so many trends that have come and gone. But I've heard you said, and I know that you say in the book, that most investors still fall for the same two traps: stock picking and market timing. Why do you think, as someone who's been observing markets as long as you have, why do you feel like these mistakes persist even among professionals?
Yeah, you know what it is? Humans have a need to try to figure out the future. So you can tell people there's a problem. There are certain parts of the future that are fundamentally unknowable. Gee, and if you really just keep pounding away on that, somebody might say, okay, so there's some parts of the future that are unknowable. But because people have this need, this innate need for planning. This is somehow embedded in our brains. This is a part of our brain. Why do we need to feel like we want the plan? Because we need to figure out what the future's like. Well, this is one of the characteristics of having higher level, brain functions in general. Humans are able to plan. Why is planning important? Planning is important to help for our survival. Humans who were able to think about where their next meal might be and not just eat this and not think about the future, like maybe I need to store some corn somewhere. People who aren't able to plan die. So the ability for humans very early on to develop a bigger brain that enabled long-term planning, that's kind of ensured our survival. So part of that is the ability to try to think in the future. And so people want to know, what's going on? Am I going to have enough food for next year? Okay, well, we don't necessarily have to worry about that. Well, will I have more money next year? What will my job look like next year? So this drives this desire to try to figure out what the future is like. Unfortunately, stock market prognostication, in fact, guessing about what's going to happen in the future in general is a really, really difficult game. And we can talk a little bit, if you want, about why it's so difficult to predict the future. But it's important to understand why people want to predict the future. It's natural. It's a part of the planning and survival process. It's also important for people to understand you don't have as much control as you actually think you do about that.
Yeah, why don't you tell me more about that? Because even the smartest analysts and economists will miss the mark pretty often.
Right. So everybody, I'm trying to make this succinct because there's a whole chapter, there's 3 chapters in my books about this. Basically, the idea is, why is everybody so bad at predicting the future? By the way, it's not just retail investors. We make jokes about them. We call them dumb money, which I think is offensive to retail investors. But there is very good evidence that it's not just retail investors are bad at guessing the stock market. Professional investors are. We know professional fund advisors have a terrible track record. 90% underperform their benchmarks after 10 years. 90%. We know that professional analysts and professional strategists employed on Wall Street have terrible records. The Federal Reserve has a terrible record of predicting simple things like where the inflation rate is going to be 1 year from now and what the GDP is going to be 1 year from now. It's so bad that Jay Powell, the head of the Federal Reserve, has said, when asked about why the Fed is so bad, said, we have a lot to be humble about. So what's the problem? Well, it's not just amateurs. Everyone's bad at this. There's 2 fundamental problems. The first is biases. There are biases that infect our brain, that they literally infect our brain, and it throws your judgment off. So a simple bias is overconfidence. You might be overconfident in your ability to predict the future. You think, my stock market picks are up in the last 3 months. I'm a genius. Therefore, I will continue to be correct. That's a bias. That's going to get you in trouble. There are other kinds of bias. Recency bias. I was right last week, therefore I'm going to be right next week. There are In the book, there are dozens of biases, and this is very widely studied. There's whole books on different kinds of biases that have been created. So these biases collectively throw off your thinking away from what actually happens. The other thing is a little more profound, and the other problem has to do with the complexity of figuring out the future. So I'll give you a quick example. Pick something easy, a Caterpillar analyst. So here's a guy, all he has to do is sit there and analyze what Caterpillar is doing. This is a big machinery company. They make earth-moving equipment and things like that. You'd think like his job is simple. One, predict Caterpillar's earnings 1 year from now. And two, based on this, predict where the stock price might be 1 year from now. You'd think, how difficult could this be? It's one stock, okay? It turns out it's ridiculously difficult. It's ridiculously difficult because the number of variables are enormous. Number one, there's the macro environment. Caterpillar could be infected or affected by a global downturn in the economy. It could be affected by something that's going on in the politics between China and the United States. Think about all the things that could go wrong in the global economy that can affect a big global company like Caterpillar. Secondly, there's micro things. There are things like competitors out there that may eat into their market share. Then there's things on the managerial level. The CEO could take ill and literally have to resign. You might think, well, what's the chance of that happening? Actually, the chances are very high because management changes occur all of the time. Therefore, this guy is sitting there, I'm a Caterpillar analyst. It turns out the number of variables this guy has to deal with between now and 1 year from now with just this one company are enormous. It's so big, it's almost like trying to predict the weather 3 weeks from now with very primitive computer equipment. You can't really do it. You can't model it correctly. So this is the problem. We are bad at predicting the future because we get infected by biases that throw off the correct way to look at things. And secondly, the sheer volume of potential information that goes into making up this analysis is so enormous, we can't really model it very well. And when you realize this, you throw up your hands a little bit. You don't say, oh, I can't do anything. I don't know anything. We're all idiots. You have to say what you want to do is really just stay with the markets and understand the historical trend. The market is up historically. You may not know if it's going to be up in the next 6 months or the next year. You don't know. But you have to give up a little amount of control of that. But once you do, you know what happened to me? When I finally figured this out, and this was 20 years ago, I spent 10 years pulling my hair out. Like, why is everybody so bad at this? It's crazy. When I finally understood it, I kind of relaxed a little because it wasn't my fault. And it wasn't like I couldn't find the one guy in the world that was the best guy who was never wrong. There is nobody. They don't exist. I used to say the search for the Wizard of Oz is futile. You calm down, you get a lot more humble when you understand these things.
Listening to you speak now reminds me of the Richard Feynman quote, like, imagine how much harder physics would be if electrons had feelings. Yeah. And you mentioned all these variables that go into the market. A topic I love to talk about is the market as a complex adaptive system, which we'll dodge for now. But I think what you've highlighted is that we ought to accept that forecasts are full of noise and bias. And so how do you feel like the average investor should be thinking about headlines and market outlooks?
I think investors should always pay attention to the headlines. But that doesn't mean you have to do something. Jack Bogle, who's the founder of Vanguard, the man who probably had the biggest influence on my whole outlook on the markets, I had many conversations with him. He used to say, don't just do something, stand there. Meaning, most of the time, it's best to have a plan and stick to it and don't do anything stupid. Imagine if you would have tried to trade around this recent market chaos. You would have pulled your hair out. You probably would have lost money, and maybe significant amounts of money. So most of the time, you need to be aware of what's going on, but don't need to do anything. I've had viewers call me up and say, oh, I don't trade, Bob. I just watch my money. That's why I watch CNBC. I'm just watching my money. So most of the investors, and many who watch CNBC, they're not necessarily active traders. They're watching their money. So the most important part of this investing game is, how old are you? How long are you going to live? If you are 30 years old, you're going to probably live to 100. That's 70 years. I'm 70 right now, almost. I'm planning to live to at least 90. My actuarial friends say, that's wrong, Bob. You're probably going to live to 95. You have an outside shot at 100. Okay, but that's still 20 years, 25 years. That's a long time. There's usually not need for me to do anything today. I might want to slightly reduce my stock ownership, but I haven't done that either. So how old are you? Most important thing. What is your risk tolerance? How much of a drawdown can you take? Could you take 20%? We almost drew down 20% this year. Well, that's a little unusual, but that isn't unprecedented. It happens every 4 or 5 years, believe it or not. How long is your investing horizon? Again, if you're 30 years old, living, another 60 or 70 years is a long time. The hardest part is just figuring out what's your tolerance and how long you're going to live. You don't know how long you're going to live, but I'm taking a guess of mine. I just told you, I'm probably going to be around another 20 years. And that means that I'm not necessarily very worried about what happens this year because I have a pretty long investment horizon. And even with that said, I have published what I own in my book. You can see it. I'm one of the few people that actually said, Peter, you get these people tell you, oh, I think the market's going to be over. They never say, what do I own? They never answer this question. But I do. And I'm mostly 70% stocks, 20%, 25% bonds, 5% money market. I've been that way for a long time. I haven't changed anything this year, but that's just me. That's my risk tolerance. I'm not preaching that everybody else should do that necessarily. I have a higher risk tolerance than most people because I'm a little more aware of market history than most people. But understanding the risk tolerance, having a plan, talking to a financial advisor, this is what matters. Not thinking you can trade around markets and not trade around this market chaos. That's for darn sure.
I think it's great that you provide the transparency around what you own as somebody who's on TV talking about these things every day. I've done the same. For anyone who's interested, whether you're watching us or you're listening to us, you can go to howpeterinvests.com. You'll see everything. You'll see how I structure the balance sheet. You'll see my portfolio, which is shockingly simple. And I do feel like for people who are regularly commenting on the financial world, I feel like it's their responsibility to be at least a little bit transparent on what it is they are doing. And you mentioned Jack Bogle drilling in these ideas that time is more in the market is more important than timing. And whether you have 20 or 25 years left, Bob, some of your money is maybe for your heirs. And so in that sense, maybe your portfolio's horizon is even longer than that. And I think that's probably true of a lot of our viewers, a lot of our listeners. And so when you see a pullback like we're experiencing now, and we almost got down 20, we're down around 10%, let's call it. This isn't going to publish for a couple weeks, so who knows where we'll be. But in reality, these aren't really that unusual of a downturn. I mean, I think of the events that you were on the front lines for, like 9/11 or the great financial crisis or COVID. I mean, how do those moments, what shaped you most as both a market reporter and an investor?
Yeah, in terms of emotional impact, when I was hired in 1990, believe it or not, the biggest thing was the downturn in some of the financial stocks. The Resolution Trust Corporation had been created. Reagan had deregulated a lot of the savings and loans, and there was a big crisis around that. And just as I was coming in, there was the Gulf War crisis, and that was pretty big. What happened for me that was really part of my DNA was the birth of the internet. In August 95, Netscape went on the air. Netscape went public, and that was sort of the new shiny object. Everyone suddenly discovered it, and our ratings went up around the interest in the internet. It was a big thing. We really rode that whole idea, and CNBC became very, very popular around investing on the internet. We also had the ability to invest at home. We had Charles Schwab accounts. You could do it online now, and DLJ accounts, and it really changed investing. Then we had CNBC too. So you had this new media to watch the stock market. You had a new way of investing through your computer, which was a new idea. And you had a shiny new object in the internet and internet stocks to invest. When it blew up, what we call the dot-com bubble in 2000, there was a significant group, a small group, that lost a bunch of money because they had all their money in simply tech stocks. And what everybody learned from that is it's silly not to be diversified. That you can't just own 10 technology stocks. It's too risky. And that's what a lot of people learned. And that was a little traumatic for a lot of people. After that was 9/11, and that was probably the most traumatic thing of my whole career because all of a sudden a lot of my friends were dead. A lot of people down here were dead. It smelled for a whole year. I mean, really bad down here. We're just a few blocks of the old Trade Center. And it was very traumatic. And there was a recession going on, and I learned to meditate. Frankly, there's a chapter in my book about how I coped with it, and meditation taught me to calm down and adopt and learn to go with the flow. I know that's a cliche, but that's what it taught me. The next great event was the great financial crisis. And other than 9/11, that was the most traumatic event of my whole 35-year career, because in March 2009, the market bottomed, and we didn't know this. We didn't know it was bottoming, but it was down over 50%, as you know, Peter, from the high to the low in 97 to 99. That was catastrophic for my generation. And what was really traumatic was I saw people selling at the bottom. As I said, we didn't know it was the bottom, but when you're down 50%, there was still significant outflows from mutual funds in March 2009. You do not sell down to 50%. You buy down when it's down 50%. So this is the point. Buy low, sell high. People don't do that. They buy high, sell low. This is when I got even deeper into behavioral economics, because it didn't make any sense. And I remember sitting on the curb outside. I almost started crying, because I knew people were flushing their savings. And I knew they were selling their real estate and their second homes. And I said, my God, this is going to take years to recover from this. And it did. We did recover, fortunately, because of the great economic system that the United States has. But it was very traumatic. And I have to say, COVID was traumatic, but in a different way. That came out of left field, although people were saying, the threat of a virus has been around for years and years, and yes, but that kind of came out of left field. Was not a man-made problem. It was an environmental, change. So I'd have to say the thing you really learn about all these crises, when you're the reporter covering these things, what people want from you, when the world is just chaotic, what they want is a sense of calm. If the world's on fire, they don't want you coming on TV acting like your hair is on fire. They want calm, rational analysis. Now, on days when the markets are boring, or long stretches when it's boring, I like pointing out the things that are interesting, exciting. I kind of play in the opposite way. But the most important thing that you'll learn as a journalist is to be a voice of reason when people are panicking. That's the thing that I constantly remind myself of. And even during this recent market panic, kept reminding people, long-term plan. Don't do crazy things like think you could trade your way out of this market. Almost certainly you're going to lose doing that. You know what you do, Peter? You keep repeating the same things Jack Bogle taught me 30 years ago. I'm still saying the same things 30 years ago because they're true. You keep thinking, oh my God, I keep saying this stuff over and over again. But there's a whole new generation that needs to hear that, because a lot of them think, well, I'm smarter than everybody else. I can outsmart them. Well, maybe you can, but probably you can't.
Great financial advice never goes out of style. And it's interesting, as I listen to you describe some of the crises that stick out in your mind. When I work with individuals, when I work with institutions, they all seem to think that they can handle volatility. And I think that they can handle the losses. But what I've come to realize is that they can't handle the narrative. It's that narrative that they're afraid of. And when we look back in history, every crash looks like an opportunity. But in the moment, the crash seems like something you should fear. And I love that you mentioned people expect you to stay calm and clear-headed on air, because you really do. And actually had a question written down to ask what your strategy for doing so is in these moments.
Well, take a breath, number one. Number two, remind people that this too will pass. Again, you get this thing, recency bias, where you think, oh my God, the market's down 5%, 2 days. Therefore, the market's going to be down 5% tomorrow and the next day. But it isn't. This almost never happens. And in the few cases that it does, ultimately, you have to ride that out as well. There's very few situations under which it is suddenly worth saying, all right, ladies and gentlemen, it's time for everybody to lighten up on everything. It's easy to say to professional investors who think they can trade around the market, who get paid to try to trade around the market, to do that. But it's not generally good advice for anybody else. So what you end up is just going back to the fundamentals time and time again. And you show things. For example, declines of 20%. We got close to a 20% decline. Peter, it was almost 19% from high to low recently. Declines of 20% happen every 4, 5, or 6 years, but almost invariably, you're made whole again within about 18 months, even after, and this happened in 2022. We were down, 18%, Peter? Peak to trough was more than that. But
Yeah,
we
and in
ended the year-
2018, we were down nearly 20%. This arbitrary 20% line, we get down 19.6, and it's basically the same thing.
Right. It makes everybody nuts. People ask me all the time, like, who decided down 20% was a bear market? And the answer is nobody. There's not a committee that got together that the holy, the holy order of stock technicians. I like to tell the story of Alan Shaw. Alan was a legendary technical analyst at Smith Barney, and he actually helped popularize this idea that 10% was a correction and 20% was a bear market. And he just did it as a shorthand to explain to people and have a narrative. And I'm going back more than 40 years. And it stuck. And it stuck because it's simple. People are storytellers, and they need shorthand ways of explaining things that are going on. And so Alan was one of the people who popularized that kind of nomenclature. But there was not a committee that got together. The press picked up on it, and people picked up on it because it's sort of an easy thing to understand. But you're right. There's not much of a difference between a 19% and a 20% decline. But if you use just a 19% decline, how often does that happen versus a 20%? You actually get some different numbers. This tells you to be careful about all that. But my point is, declines of 20% are fairly uncommon, and most of the time you are made whole within about 18 months. And that's another good shorthand of telling people, don't panic.
The one common thing about crises, they're all a little bit different, but they all do eventually end. And you make a good point. I think storytelling is so important. It probably always has, but for some reason it seems more so than ever. I'm curious. I think that you're a great financial communicator. Are there things, is that one of them, or other things that you feel like make somebody a good financial communicator today, especially when you're standing between the chaos of markets and millions of viewers at home?
I don't know. As I get older, I get more humble about this stuff. I used to be a little cockier, and after I lived through the dot-com bust and the 9/11, and I got really much better at understanding behavioral economics and behavioral finance, and I realized like a very large part of this performance in the stock market. I used to think like, I'm analyzing the fundamentals, and the stock market is a discounting mechanism for a future stream of dividends and earnings. The problem is it actually doesn't exactly track. It roughly tracks, but not exactly. And so there is a speculative component in the stock market that exists. We call it the market multiple, the PE ratio, that sort of accounts how much you're willing to spend for a stream of earnings. Okay, so you have a certain stream of earnings. Well, all right, how much am I willing to spend for that stream of earnings? Will I pay, for $1 of earnings, will I pay $10? Will I pay $15? That's the market multiple. And that's what accounts for a significant part of the market's performance over the years. And that multiple changes depending on how people's outlook about the future of earnings change. Well, heavens, that's not exactly a scientific, that's actually a guess. That should make you much more humble at this point. So I sort of like engaging in quiet, folksy behavior and telling stories. The person who influenced me the most, other than Jack Bogle, was Art Cashin. Art Cashin was the head of floor trading for UBS and was a legend down here. He became a floor member in 1965. He passed away in December. And Art Cashin was never a stock market academician. He didn't like academics, even though he understood what they were doing. He told stories. And when I first met him in 1997, there were 4,000 people on the floor. And boy, I had no friends at all. They didn't like reporters. They didn't trust them. And Art Cashin stood up for me and said, this guy Pisani, he's okay. You can talk to him. And he's not going to go blab your name on TV, which is what they were afraid of. And he taught me, don't pepper everything you're saying with numbers. Learn how to tell a story. Learn how to say, Bob, if you use a number, say 3 out of 4 years, folks, the stock market goes up. That's better than using a whole bunch of statistics. They'll remember that. And if you put a human being on it, Jack Bogle once told me, and I basically adopted what he told me, what he taught me. I read the academic reports, but I like to pepper. Jack Bogle told me stories, or stories about people on the floor, about stories in my book about meeting people like Aretha Franklin and Barry Manilow. Had a very interesting discussion with him about how to manage your career and the importance of staying with what you love. And you learn how to tell a story and make things work for people. And that's why I love being a journalist. If I wasn't a journalist, I'd probably be a college professor, to tell you the truth. But I always like data. I always love information. I love the art of explaining things. I always feel like I could explain, general relativity theory. I always wanted to be a science reporter, as well as I could explain the stock market, because it really is about how you approach the information and make it understandable to people. And if you ask me, what are you really good at, Bob? People say, oh, you're a stock market expert. Yeah, but not really. If you ask me what I really am, I'm really good at explaining things. I'm really a journalist, and I'm a journalist that covers the financial markets, but I could have been a journalist that covers science just as easily, and I think I would have been happy doing that as well, but fate didn't step in on that way.
I'm sure you would have been wonderful in that realm as well. And you mentioned some of the market legends and celebrities you've met. I'm kind of curious, the bell ringing that happens on the New York Stock Exchange. I remember my first bell ringing moment, and I've seen a few now, but is there one moment in particular or any kind of celebrity interactions that stand out to you in particular?
If I had to pick one month that really changed my life, December 1999, this was the height of everything. I mean, talk about party like it's 1999. I mean, there was a song about this, but it was insane. The markets were going up, .com, the internet was roaring, and these New York Stock Exchange had a series of bell ringings that I've never had a month like this before. So I shook hands with Muhammad Ali. I mean, I can't tell you what it's like to spend 3 minutes with Muhammad Ali alone. It was really wonderful experience. I spent a lot of time with Jack Welch, the head of General Electric. He was my big boss. General Electric owned NBC. He was a huge influence on me. He was like God. I mean, talk about overconfidence. I believed anything Jack Welch had to say. The whole market did. But if you ask me the one person that I wrote, Walter Cronkite came on the floor, December 99, a few days after Muhammad Ali. Walter Cronkite was the most famous anchor of my time. He was CBS's anchor from 1960 to 1981. He had retired 10 years before. And I was terrified of him because he had been very critical of the whole ballooning cable TV industry. He didn't like anchors and TV reporters that he thought were engaging in punditry, meaning making comments on the news rather than just reporting the news. So I have a picture with him, which is one of my cherished possessions, and I was terrified he was going to, interrogate me because he was angry about these TV reporters who become pundits. And instead he said, I'm absolutely amazed that the stock market is such a big story. It wasn't when I was an anchor and we had a markets correspondent, but we never had him on. Why do you attribute this? And then I'm thinking to myself, this is the greatest moment of my life. Walter Cronkite is interviewing me. This is so cool. This is the greatest thing ever. And I have a picture with him. It's just wonderful. The only other thing I would say is a couple of quick bell ringings. Jimmy Page came to ring the bell, 2005, I guess. He was the lead guitar player for Led Zeppelin, big influence of my generation. We were rock and rollers, so everybody showed up. Old guys on the floor with worn copies of Led Zeppelin albums. They wanted Jimmy Page to sign. And Warner Music was going public, and Page had come, and they were going to, normally you push the button to ring the bell, and the bell rings. So instead of pushing the button to ring the bell, Jimmy Page plugs his guitar in and starts playing Whole Lotta Love, which is famous Led Zeppelin. So, and the floor goes crazy, and I'm screaming and yelling, and we're waiting for him to come down the stage, walk down the stairs off of the podium to shake everybody's hands. And I'm standing there with my microphone when I talk to Jimmy Page, and there's 150 guys behind me. And the head of Warner at the time comes down, and he's alone. And I said, "Where's Jimmy?" And he said, "Well, Jimmy took a right, because if you come down the stairs and you go right, you go on the street. If you go down left, you come on the floor." And Jimmy took a right, and he said, Jimmy doesn't like talking to crowds. And Jimmy Page actually has a little bit of a sensitivity about talking to crowds, which sounds ridiculous. But people were just screaming. And you could still see that on the internet. And in the book, there's several anecdotes about talking with Aretha Franklin or Robert Downey Jr., or even, as I mentioned, Barry Manilow, who had a wonderful little discussion with about careers and the longevity of his career and how wonderful it was to stick to things that you really love. And after a while, if you stay with it long enough, suddenly people start calling you a legend. And I was curious about why Barry Manilow was still so popular. And he explained it to me. He said, I know I don't have the same hits that I had in the 1970s and 1980s, but I have a loyal fan base. I've been putting out albums the same way, and I love what I'm doing, and it never died. So he said, if you stay with it long enough, suddenly people start calling you a legend, and you sort of have another career again, because people start saying, oh, look, he's still around. Look. And he said, my fan base never left me, but everybody who forgot about me came back. It was really very interesting discussion. So who knew? Like, Barry Manilow actually has a very profound kind of understanding of the arc of a career, which you can generalize into a lot of other people's careers, including mine. I stuck with it for 30 years, and there were several moments, including after .com and 9/11 and the financial crisis, when I considered calling it quits because my heavens, I've been here 20 years. What else do I have to show? And it's kind of a tough time, the financial crisis, but I stuck with it because I loved it, just like Barry Manilow. So what he said really kind of like, yeah, I did this too, just like you did, Barry. So who knows? This is what's fun about this. Occasionally you meet people and they surprise you in pleasant ways.
It's interesting you say that, because when I started a podcast, I had no idea how much fun it would be to meet a number of people. Some I just got to know better and I'd already known them. Some are people I met for the first time. I mean, I think I shook your hand in person for the first time no more than a month ago. And hearing you talk about being curious about the people you are interviewing, I guess let me close with one final question. Having had a front row seat for the last 3 decades of market evolution, I mean, is there anything that still has you curious?
I'm curious about the ability of people to sort of really learn new things. One of the things that's frustrated me is when we started CNBC, we were so excited about this because we're thinking, oh, this is going to be a TV station about investing. And it became the stock market investing network. But really, in the beginning, it was about investing in almost anything. I was the real estate correspondent. So we were, this is going to be great. We're going to teach everybody about investing. And we have. And I've been very proud of CNBC and everything it's done. But, it's amazing how much education there still is to do out there. So I'm really curious about trying to find new ways to sort of connect it with people and educate them more about making better decisions in general. I mean, I'm the stock market guy, so I want to make them better in financial decisions, but just better life decisions in general. It alarms me a little bit, the stupidity and the misinformation of stuff that you hear out there. It doesn't help at all. And if there's anything I'm still curious about is how do we get better education for people? And I'm always hopeful that things like AI can help do that. Seems to me like a natural teacher for people, but you could misprogram AI too. So that isn't necessarily, it's garbage in, garbage out. Doesn't necessarily help. But one thing I'm really happy about is now as I am approaching my 70th birthday, I haven't lost my interest in the world. I haven't lost my curiosity. My wife always says, you've never changed. You're still watch science fiction movies and you still obsess about the stock market and you still like writing and being a teacher. And that is what I am. I consider myself a journalist and a teacher. And I'm really happy that desire, that thing that makes me happy has not died. So if there's anything I'm grateful for, there it is.
Bob, I absolutely love that. And I love everything you shared today. I wish we had more time. For those of you listening, I'm going to link to Bob's book in the show notes at thelongterminvestor.com. Bob, if people want to follow along with you online, what's the best way to find you?
Well, you can look at tradertalk.cnbc.com. Usually I will put some thoughts in once or twice a week about where I think the markets are, and sometimes just general ideas on life in general.
Absolutely great. Bob, thank you again so much for joining us here on The Long-Term Investor.
Thank you, Peter. Always a pleasure.